Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Here's the dollar CAD. Now, the dollar CAD short-term in the spot markets is one of our least favorite currencies, the Canadian dollar. Yeah, right, exactly. Drives us absolutely insane. But over the last year, for example, look at this. Dollar has lost some ground, spent the majority of its time it had a huge dip below, found a barrier. But look at the barrier on the top side. 2 points away from the daily simple moving average, the 62 simple moving average, or 4 points away from the daily 62 simple moving average, seems to be a barrier. And at those barriers is when we might want to start thinking about an options contract that goes the other way. For example, let me erase all this. For example, let's do a real-world example. Oh, that's nice. Right there, let's say that the price of the options contract, let's just for the sake of argument, say it's 102.5.
Okay.
So it's 102.5. And let's say that the 800 at that point in time, let's say that we want to get back down to, not the 800, let's say that the 62 is at 99, even. And it's 3 points away or 4 points away or whatever it is, so it's 3.5 or 4 points away, and we buy a put. And we could buy a put with a strike of 99, we could buy a put with a strike of 101, we could buy a put with a strike of 100, and we could look at the time here, and we could do an expiration of 1 to 3 months out in time, and then we can wait for this whole correction. I'm going to erase everything here. I'm going to erase that. And we could wait for a correction back down this way. I'm trying to erase what I just wrote. We could wait for a correction. And as that corrects, this is what happens to your put contract. It's just a straightforward, I'm not recommending any trades right now. I'm looking at a historical example.
Sure.
But you simply could express it. You could say, hey, listen, it's 4 points away from the 62 on the daily chart. I'm going to buy myself a put. I'm going to make an expiration of 101.50 or 100. I'm going to give myself a time frame of 3 months. And then as the price falls, my options contract becomes more valuable. And the faster it falls in a shorter time frame, which you can see it really did, the more valuable it becomes. Because if it falls down to 101 within 2 weeks or 3 weeks and you have 2 or 3 months left on the contract, you've got all this time left to fall even farther and volatility is increasing.
Right.
Your options contract becomes much more valuable than when you bought it. Let's look at an example on the euro chart. Time left to fall even farther and volatility is increasing.
Right.
Your options contract becomes much more valuable than when you bought it. Let's look at an example on the euro chart. Wow, all that stuff stayed. That's really interesting. All right. Let's say, for instance, Dave, that the euro falls 3 points below the 62 simple moving average on the daily.
Okay.
And let's say the price is 62.
Okay.
Even. That's the 62. That's where we're at right now. And let's say we think we could get all the way back up to this area, 66. I never go right back to that area evenly. I actually go back up halfway the distance, for example. I might buy an options contract halfway the distance between the where the price is and where the 62 is. So let's say it's 4 points away, and let's say that I buy a call with a strike of 64, or I even buy a call with a strike of 63 or so. Well, within a short period of time, it starts to go up. It's actually just from May to July, really, it starts shooting back up the opposite direction.
Yeah.
Now, my call becomes more valuable in two ways primarily that I want to speak of. My call option becomes more valuable because it's the underlying price of the pair has moved closer to my strike price. So my strike price is 63 or 64. As this currency pair rises, my options contract becomes more valuable. Now, the faster it can start rising, the better it is, because I have, time decay is going to be on my side rather than against me. Mm-hmm. So if in the first couple weeks I can get up to 63 and volatility starts to increase, price starts to move upwards, and I've got lots of time, I've got actually three things in my favor. I've got volatility in my favor if it starts to move in the opposite direction. I've got time in my favor if it starts to make that move quickly. And I've got price in my favor because it's starting to move in my direction. Now, in the currency markets, in the spot market, if this started to move against me before it started to move for me, I'd get wiped out. I could wipe out my account because it could move 300 points against me. Well, in the options world, I don't care. I bought time. And one of the things that we're buying when we do an options contract, which is kind of cool on these, is we're buying time. I think that, Dave, people who time the market, it's going to get to X price by whatever. Mm-hmm. That's just madness. Yeah. And that's not what we want to do. With an options contract like this, with given enough time, and on the daily chart, when we get 4 points away from a 62, I think an options contract with an expiration 3 to 5 to 6 months out is perfectly acceptable and gives us plenty of time. Now, if we want to make a little bit more money, we might buy an options contract with an expiration that's 2 months out. But you got to remember your risk to reward ratios, and you got to make sure you never risk anything that's too much. And you always want to compare the price of the option up front. If you're going to do a debit, you want to consider the price you're going to pay for this in exchange for the potential value of what it could mean depending on the time frame. And you've got to get up to date on all of your options information. You've got to make sure you get the basics down. And you get somebody that helps you. You got to get somebody that knows what they're doing. It's always good to have a friend that's more experienced than you, trade along with you. Never do any of this stuff and risk a substantial amount of your money, and never trade before you understand the product that you're trading. All right, so those are two examples of how volatility, time, and price can all work in your favor. Here's another example. I think we just used that example. And here's the dollar CAD right now. So this is the dollar CAD right now, and as you'll notice, the 62's at 1.0104, and the price is just barely lower. It's down at 0.0006, and that's really 1 point away. That's 1 point away. So nothing's really happening yet. We're too close. Oh, look at that. That's kind of cool. Yeah. I can erase each one of those individually. WebEx rocks. All right. So nothing's really going on with these right now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.